It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the show. With me in the KFG studios, certified financial planners, my friends, business partners, colleagues, the list goes on and on. Kevin Korhorn and Josh Gregory.
Are you trying to guess where the market is going? Is the stock market too high and you should run for cover? Or do we still have a few more years of growth ahead of us? And that's what we're going to be discussing today. We're going to be trying to read the tea leaves as we discuss the best indicators of the long-term stock market and what they are telling us right now.
I tell you, every single week we're talking about what you're thinking about. And this topic's pretty heavy, but I'm sure it's what you're thinking about. The market's high. We are now officially in the longest bull market ever on record, although there's a nuance that says that might not be true. But this is what you're thinking about. Is the market too high? What should you do? That's what we're talking about today. If you have questions, we would love for you to reach out to us. We'd love to address it on an upcoming show or help you wherever you're at. You can find us online, wisemoneyradio.com. Submit a question right there, or reach out to us right there. Latest blog is there as well. You can find that right on the same page. You can find us on social media, Facebook, Twitter, YouTube. Just search Wise Money Radio. And also, you can call or text 574-222-2000. That's 574-222-2000. So one investment manager coined the phrase that trying to predict the stock market in the short term is like trying to predict the flight pattern of a leaf in a hurricane. Now, I myself have never been in a hurricane. Tornadoes actually scare me, but I can imagine that'd be pretty unpredictable. Long term, even a leaf in a hurricane, that hurricane will pass, that leaf will fall to the ground. So long term, it's pretty obvious where the market should go. But I think this is a good analogy of trying to guess where the market's going to be day to day or week to week. There was a article in the Wall Street Journal a few weeks ago written by Mark Holbert. Kevin turned me on to it, and it's really interesting. We're going to break it down today. The title of it, I've got it right in front of me, The 8 Best Predictors of the Long-Term Stock Market. And I'm just going to go ahead and read the first line here. The stock market's return over the next decade is likely to be well below historical norms. End of paragraph. We are going to get into why he says that. But first, is it even important? Is this relevant in the big picture?
Yeah, that's the right question to be asking. I mean, should you even be on the hunt for some sort of crystal ball that maybe helps you predict where the turning points are in the stock market? And I was remembering back, it's, I guess, been about a year, or 10 years ago, rather. I bet at that time, 9 out of 10 books that I was reading had to do with this subject. What are the best indicators of where the stock market's going? Because remember, at that time, that's when the stock market crash, we were well into it, and everybody was caught off guard by the magnitude. Most people understood that we were heading into a recession, but no one would have thought that Lehman Brothers would be allowed to go bankrupt, and then the domino effect that came after that. But when you're going through that, especially if you're guiding clients through it, you start asking questions like, man, was this predictable? Is this something that really could have been foreseen? And everybody and their brother had some sort of an indicator that they were saying, oh, this is the one. This is what tells you where the stock market's going. And if it were true, there wouldn't be hundreds of books on the subject. There would be one. Right?
Thousands of books. There would be one. Right.
Now, this particular author in the Wall Street Journal has boiled it down to the 8 that he says. Mm-hmm. These aren't even the 8 that necessarily I would have picked. Mm-hmm. But the point is, it's the wrong question to be asking. 10 years ago, I was thinking we've got to have a great indicator of where the market's going, and that way we can protect clients from ever experiencing down markets, or at least limiting the effect. And now, I don't know if it's wisdom or just time or what, but I feel like our attention needs to be a whole lot more on the behavior during those times and the habits that people have. Because looking back over the past 10 years at how well our clients have done, even in spite of 2008, it had to do more with their behaviors than their ability to time the market.
And we're going to be talking about those behaviors here coming up, but go ahead, Kevin.
Well, yeah, so when I started my career back in 1994, the Dow Jones Industrial Average, which if you listen to the radio or other things, they want to talk about the Dow and what's the Dow doing. It's 30 stocks. So that is not the market, but it is one segment of the market, and lots of people tune into that. So the Dow was at 3,754 when I started. And it's interesting because as I was going through some mementos that I have, I found a term paper that my dad had when he was going to Fair State Institute, which became Fair State College and later Fair State University. And it was the Dow, when he was writing his term paper in 1967.
500.
Good. A fuzz shy. 879.
Ah.
So in 1967, when I was just a twinkle in my dad's eye, it was 879. In 94, when I started my career, it was 3,700, 3,700, let's say, and today it's 25,000. So the interesting thing is when I started my career in 1994, I had a degree in finance from Central Michigan University, and I'm thinking, okay, I am helping people make investment decisions. I'm a certified financial planner, so that's not all that I do, but it's a component of my job. And I concluded that the only way to be really good at investments is to have 50 years experience. So I thought, how do you start a career with 50 years experience? And I realized you couldn't. So the closest you could come to that would be to be an avid student of history. So I studied the stock market crash of 73 and 74, and I didn't really see anything negative in client experiences, client returns until the year 2000.
Right.
So from 94 to 2000, the first 6 years of my career, the only direction that the stock market went was straight up. And I thought, okay, if the market is going straight up, I need to study what happens when it doesn't, and I need to be preparing for that.
Well, we're going to talk about that because the market's been going straight up for 10 years. And it's not straight up, I know, but it's been up for 10 years. And so a lot of people have had kids who have never seen a recession. Right? My kids have never seen a recession. You might be an investor for the first time. Maybe you launched your career 9 years ago, and you've never seen a market downturn. It's worth talking about, and we're actually going to be talking about that in just a little bit. But I want to draw something out of what you said, Kevin, before we talk about a couple of these indicators. That's what you should be thinking on. When are you going to need this money? Because if your dad writing that term paper, or you when you launched your career, were really focused and really nervous about where the market was going to be the next year in 95, or for your dad, I can't remember what year he wrote that, but the very next year, you would have missed, you possibly could have missed that incredible run from 800 to 3,700 to 25,000 if you were always just focused on what's next. That's the danger of this. At the same time, this is interesting, and I think just as humans, we try to make sense out of nonsense, and we try to predict and try to protect ourselves from dangers, and the investment world can bring some dangers. We're going to talk about these 8 indicators, but the very first one. Well, no, let me say this before we get into this.
Can I answer the guy's question? I mean, he's talking, the stock market's return over the next decade is likely to be well below historical norms.
That was a statement, not a question. But
right.
Yes, you can answer a statement.
So in the form of a question, I'll give you a statement. Here's the deal. If it's going to be well below historical norms, that is fantastic news for those of you who are buying. And the other thing is, this guy is writing, right?
Yeah.
So he gets paid to write and create content. Is he right or wrong? No one will ever remember if this guy was right or wrong.
Yeah.
So anyway, this is great news. If you're an investor, that's the best news you've heard all day.
Well, let me shock you. The very first one, the very first indicator that is the most reliable, and by the way, it's not that reliable, but it's the most reliable of the ones that are cited here. actually deals with investor behavior in a contrarian way. When everyone's betting one thing, consider betting the opposite. That and more coming up here on Wise Money with Korhorn Financial Group.
Hey,
That's it. That was fun.
I think there's a lot more of my story that needs to be told. I mean, that's what I'm thinking
That's
about this.
the central part of your worldview, actually.
Yes.
There's more of me that the world needs to hear about.
As the world revolves around me.
I think we can hit both, but this actually makes me feel good. I didn't really want to get into what is the Q ratio and what is all this stuff. So I think we just mention them, but then
Right. Because I still actually I still have some more stuff to say about this. Are you going to
About what?
Well, so are you going to get into the household stock equity allocation?
I think we just need to communicate. Hey, here's what some of them are, or here's what they are, and they are showing.
Because there's a person in my life who, back at the very tip top of the real estate bubble, said, I'm going to get into real estate. And that person did and has regretted it. This same person I saw recently, and they said, can you believe how tech stocks are doing?
Yeah.
And I thought, okay, I am.
Well, that's the very first.
I'm going to run and sell all my tech stock
That's
holdings.
the very first ratio the guy is talking about. But so let's hit these, and then it bleeds into what should you be doing about it. So that's the behaviors, that's the habits, that's the, and then we're going to have another chance to hit that at the end of the show, behaviors, habits, and all of that. So I think we do launch into what, at a high level, what these are, and really just what they're saying.
Yeah,
Do you agree? I don't think we
Sure.
go through one by one and say, well, this is the Q ratio,
No,
and this is what
no.
this means.
No, we do not. Let's tell people what time it is, not how to build a watch.
Agreed. So we'll hit the at a high level what the ratios are saying, and then go into behaviors. Sound good?
Yeah.
Let's rock and roll. Could your behavior be telling you a little bit about where the market's going? That's an interesting question. We're going to answer that here in just a second. This is Wise Money with Korhorn Financial Group. Thanks for being with us today. My name is Mike Bernard, here with me at the world headquarters of Korhorn Financial Group and in the KFG studios. Kevin Korhorn, Josh Gregory. Special thanks to the attorneys at Ledoux, Kern & Keene, as well as First State Bank for sponsoring the content of today's program. And if you have a question, once again, let me just remind you, you can find us online, wisemoneyradio.com. Call or text us, 574-222-2000. That's 574-222-2000. You can watch every episode. Actually, Josh and Kevin right now are being very studious. What are you guys doing? You're writing notes and highlighting? Wow.
I'm taking notes on everything you say, Mike.
I am very impressed. We had some technical difficulties with the video the last couple of weeks, but we're on, so you can find us there. Just search Wise Money Radio. You can find us on YouTube and, Facebook and Twitter as well. All right, we are talking about what you're thinking about, and that is the market too high? Where's the market going to go? And we already addressed that's dangerous thinking. Dangerous thinking. We're going to talk about habits and really what you should be focused on and having maybe an investment philosophy and overall strategy as opposed to just being scared of your shadow or looking at what could tomorrow bring. Well, tomorrow's Sunday, market's closed, so I mean Monday. You know what I mean. But what are these ratios saying? What are indicators saying about where the market's going?
Yeah, most of these indicators, the direct answer is they're saying the stock market is expensive, right?
Yep.
Now, you may have been thinking that anyway, just because you hear, oh, the stock market has hit another all-time high. And so just getting to a high dollar amount for the Dow Jones Industrial Average must mean that it's expensive. But just like everything else in life, it's all based on, well, what are you getting for what you're paying?
Mm-hmm.
Is $50,000 a lot for a car? Yeah, it could be. or maybe it's a really good bargain on a very expensive car. Who knows? It just depends on what you're comparing that price to.
And the stock market's always supposed to go up. Over time, we should be hitting new highs and new highs. It's not something that bounces around in a flat range over the long term. No. Just like prices of everything go up over time, so do values of businesses. And that is what is made up in the stock market.
That's right. You know, the very first indicator that's listed in this particular article is referring to what portion of families' kind of net worth or their assets are invested in the stock market. Okay, and in other words, how heavy have you gone into the stock market as compared to maybe some safer investments like bonds or real estate, other things like that. And the interesting thing is that throughout history, there's been pattern after pattern, just demonstrated over and over that we kind of herd all in the same direction, and it's often the wrong direction. When the stock market is hot, everybody wants to pile more and more and more in, and so it becomes a bigger and bigger portion of your overall net worth, and that's often at the exact wrong time. It's at the bottom of the market when things are cheap. That's when we should be piling in like crazy, but it tends to happen more after a long run up that everyone feels like, man, I need to get some more of this because everything just keeps making money for me.
Can I don't know if I'm going to be able to communicate this well, but supposedly the most reliable indicator only has about a 50-50 success rate, by the way. And statisticians out there will say, no, that's not exactly right, but it's pretty close. That's the most reliable one at 50-50. And it's based on your own guess. So you've guessed, or investors have guessed and said, I'm going to load up on stocks right now. And this ratio says, yeah, most of the time when you load up too much on stocks, you're wrong. So stop guessing. Right now, this article is baiting people into guess. Make some other prediction. And I think it just is a clear indication of the dangers of making these predictions. Because the very first indicator says if you're predicting and want to invest in more stocks, once that hits a certain level, that might mean you should do the opposite.
Yeah, and I look at this and intuitively it makes sense to me that households would have more of their net worth in stocks, bonds, and cash because it used to be the way that your retirement looked is you had Social Security and a pension from the company. Well, that pension from the company, that check that hit your mailbox every month, represented the goodness of stocks, bonds, and cash that the company had invested on your behalf, and they were taking an income from it. So as I look at this, and as the pension has gone the way of the buggy whip, I think, okay, it makes sense to me that more people would. But I think if you are an investor, really, I believe the investors have all turned off the radio and have left. Because if you're an investor, you're doing things based on guiding principles.
On a process.
And you have a process that you follow. And I was just having a nice conversation with a friend this past weekend, and he was saying, so why doesn't everyone just do, put money in a Vanguard index fund? And I said, well, that's not a bad, it's a tool. It's not a bad thing.
We're going to be talking about that on next week's show, by the way.
Yeah, but here's the thing. The average investor, according to the Dalbar study over 20 years, the market did 11% and the average investor did 4%.
And this indicator basically says the same thing. Be wary of where investors are betting, which is just interesting to say, well, then maybe you should bet differently. Stop betting. Have a process.
That's right. That's the answer. Don't bet at all.
And that's what we help the new advisors, the up-and-coming certified financial planners in our firm understand, is that if you are emotional about your money, you're going to make bad decisions. Most people can't be unemotional about their money.
Yeah. So let's just round out the article, and then we need to talk about habits and what really you should be doing instead of talking about just kind of the fodder here. But so the rest of these indicators, so things like price to sales ratio, price to book, the PE ratio. There's a lot of jargon in there, but they're all reading that the market's expensive. They all are right now. We look at some other research as well. We get research from all sorts of places. We are totally independent, so we get research from all sorts of places, and we've got other not indicators, but readings on the market that show it's appropriately valued, not overvalued, where these are all saying that it's overvalued. So if these indicators that this person is this writer, not financial planner or investor, is saying, hey, the markets could be overvalued, what should you be doing about it?
Well, we just got done talking about how a lot of households are starting to overload a little bit heavy into stocks. That can happen just naturally because your stock investments have grown more than everything else.
Exactly. What if you just kept it in that target date fund? Not recommending, just stating, kept it in that target date fund, but your stocks have grown and your bonds really haven't.
That's right. So one of the most disciplined things that you can do within your investment portfolio is to rebalance. And it's basically a way of pruning back the stuff that has grown faster and maybe pouring a little bit of fertilizer on the stuff that hasn't grown as much to keep your overall portfolio shaped the way that you intended originally.
Yeah.
And by doing that, by selling some of those stocks and buying some of those bonds and other real estate, you're essentially selling high and buying low.
Because bonds right now are negative for the year, and first time in a while. It doesn't happen that often, or at least not since interest rates have been on a 3-decade decline.
Yeah, interest rates go up, bond prices go down. We're seeing a negative year in bonds. And just beware if you're rebalancing, if you are not doing that in a retirement plan, of the tax consequences of doing so. Some of you should be doing that because your capital gains rate is 0.
Right.
So you should be doing that. Some of you shouldn't because your capital gains rate is 15 or 20%. So make sure you're working with your certified financial planner to make these decisions.
Especially because your certified financial planner will help you tie your investment decisions to the goal that those dollars are matched to. If retirement is on the horizon here and you need to be paring back a little bit of that risk, maybe now is a good time to be doing that, but they'll be able to help you get the right level of risk within your portfolio for the next stage of life that you're coming into.
Okay, so I hear you, and I completely agree. Make sure you're rebalancing. Beware of the tax consequences. Make sure you're rebalancing within a process. Don't just sporadically do it. Okay, here's a question. Should you continue to save into equities? We've got that and more coming up here on Wise Money with Korhorn Financial Group. All right.
So we're actually right on track with
your
outline, huh?
Yeah, sort of. Don't jinx it, Josh.
Oh, sorry.
Hockey player.
So
Everything's a jinx. Yeah, sort of. Let's hit a few of these others, and then
the other what? Ratios?
No. We're past that. It's all right. What should you be
Other
doing about it?
actions,
And I think
behaviors.
that's how I built the outline. That leads right into. It's not an infomercial, but it leads right into. Well, one thing you should do is make sure you have a process for managing your investments. Here's the process that we have at KFG.
So we're going to hit that in this segment or next segment?
I think this segment we're third.
Okay, so who's going to talk about our process?
Josh.
Okay. You back clean up then. You fix everything that I say wrong.
I'll be talking about Josh.
I talk too much, so it can't be. Shouldn't be me. So, all right. Third segment.
Hit it.
Thank you so much for being with us today. This is Wise Money with Korhorn Financial Group. I'm Mike here with Josh and Kevin in the KFG studios. Thanks for being with us. Thank you also to Bethel College Adult and Graduate Studies, as well as Diane Bennett with REMAX 100 for partnering with us on the Wise Money Show. Thank you. Thank you very much. Couldn't do it without you. We are discussing what in the world the market's going to do tomorrow, which is anyone's guess. But Wall Street Journal posted an article about 8 different indicators they claim are the best indicators. and what they're all saying. And therefore, that leads into what should you be doing about it? That's exactly where we're at. What should you be doing? If you have a question, need some help, whatever, reach out to us. You can find us online, wisemoneyradio.com. You can call or text us, 574-222-2000. That's 574-222-2000. And you can reach us on social media as well. Facebook, Twitter, YouTube channel, they're also Wise Money Radio. You can find us that way. So, 8 different indicators. Each of them, the most successful is a 50-50 chance of being right, and then that goes down from there. So these aren't, this is no crystal ball. There is none out there, right? But these particular ones are saying market's high. We're looking at others that say the market's appropriately valued based on expectations for the economy, and actually, that's what the stock market is. It's an average of the guesses of what we expect the businesses to do over the foreseeable future. I mean, so in and of itself, the stock market in a way is an indicator, right?
It is, and that's really counterintuitive because most people hear things like low unemployment and strong growth in the economy and believe that that translates into future great stock performance. But they don't realize that the stock market is predicting where the economy is going,
Right.
not the other way around. And so long before the economy starts to falter and go into a recession, the stock market will begin its slide in anticipation of that economic decline.
Right. So
It's the
you're
exact opposite of how you would think it would work.
So you actually trying to find that crystal ball, you're trying to predict the predictor, which again, you would just assume that your success is not going to be that great. So, but what should you be doing about this? Okay. And Josh said, absolutely rebalance. Make sure you've got a systematic way of rebalancing. I completely agree. I would also argue, continue to save into equities. This is not the time to say, all right, well, it might be a little tough. Let me switch my 401k contributions to just go into cash. If you need to downgrade your risk for your overall retirement plan, if now's the time, say, you know what, I need to downgrade my risk, I would rebalance your allocation, but continue to invest in the stocks, because if it is a bumpy ride over the next 5 to 10 years, like Kevin already said earlier, you're welcome. I mean, that's great news if you're investing. Only if you're investing in stocks. So.
You're echoing the conversation I'm having with clients over and over right now, as many of them are coming up on the eve of retirement, and we're trying to get the portfolio positioned in a way that minimizes some of the risk, especially if a bear market could be coming in the next 2 or 3 years. And in doing so, though, I'm careful to point out that, yes, they need to still stay more aggressive with their future contributions, because you want your new dollars, money that you're saving out of each paycheck, to be going into investments that are on more of a roller coaster ride. Those investments that could get cheap at some point here, that they could represent some bargain, buying opportunities. And you're only going to take advantage of those if you're staying more aggressive with the future contributions that are going in. That's called dollar cost averaging.
That's right. And something else to consider, when this is the traditional thinking. Okay, stocks are high, and I want to do something about it, so I will sell stocks and buy bonds. Oh, be very careful. Be very careful with that, because if you're wrong, if that bet is wrong, and the economy continues to plug along, maybe it's a little slower growth, but it still is trying along. We are in a rising interest rate environment. So your bonds carry more risk with them today than they have previously. So you could get out of stocks to avoid a downturn and go right into what you are trying to avoid. Now, I hear you. A bad year in bonds is similar to a bad day in stocks. I get it. But you might be simply accepting. What did the article say? Over the next 10 years, there's a decent chance the market will just do a little bit over inflation. Listen, bonds might not do that at all if we stay in a rising interest rate environment. So just be very careful about that. So I would also argue manage diversification, but above and beyond. And Kevin, I'm stealing your thunder a little bit. You've got to tune into your financial plan. That's what you should be. So what should you do with this information? You should look to see if you're on track with your goals. Look at your financial plan to make sure you're on track. You just can't make investment decisions in a vacuum outside of what your overall financial plan is and what you're trying to accomplish.
Right. And remember the tools that you have, the most powerful tool that you have for accumulating wealth is likely your income and the places that you can save income into, whether that's a retirement plan at work or it's something that you set up outside of work. But systematically investing is by far and away the best way to accumulate wealth. And when you do it systematically, you can turn a blind eye to this because there's this thought that, hey, I need to figure out what the market's going to do and then make my decisions. And that it's completely backwards. You need to make your decisions and then not care what the market's going to do.
That's exactly right. One of the other things that I would say, and this is going to lead us right into what we wanted to address next, is with all of this information, you need to have a process. You need to have a process, a systematic way of managing your investments. That way, you can avoid the noise that is plastered on the front page of this Wall Street Journal section. And, the Wise Money Show is not an infomercial for KFG. It's not a commercial advertisement for KFG. It is a love story about financial planning. It's really communicating this is how you need to approach your overall financial life and give you some nuggets and some perspective to help you along that way. But, Josh, let's share a little bit of our process and philosophy on managing investments. It seems appropriate in light of what these indicators could be saying.
Well, I know I'm kind of piggybacking on what you guys just said, but the investment planning, the investment decision-making process is a subset of the financial planning process. And you use the financial plan to define what your need is and what you're trying to accomplish with the investments. No one's out there, or few people, I should say, are out there just growing their investments, just trying to build wealth just for the sake of building wealth. There's a purpose, there's a goal attached to the money that you're trying to accumulate and grow. Often we think of it as retirement, but that particular goal, defining what your investments need to do, what part are they going to play in helping you achieve that retirement goal is the first step. It's what allows us to figure out, well, how much risk do you even need to be taking with your investments? How much rate of return do you need to be able to achieve so that the goal is achievable? And again, how much risk you're taking is just part of the equation. I would be asking questions like, well, are you willing to work longer? Are you willing to save more? Are you willing to spend less in retirement? All of that can have an impact on how much risk you're actually needing to take with your portfolio. But let's say for a moment that you've gone through that process with a certified financial planner. You know what kind of rate of return your investments need to achieve. Now you need to go craft a mix of investments that will help you have the best shot at actually achieving that. In our world, we recognize that there's actually 3 different investment philosophies used out there, 3 different ways of picking those investments. And we don't believe that one of them is better than the other. We don't think one's great, you need to avoid the other 2. They all have merit. They all have strengths. They also all have Achilles' heels, okay? And so in our opinion, how you piece those 3 together, how you balance 3 different investment philosophies is going to control what kind of roller coaster are you experiencing, what kind of emotions are you going to encounter as you're building towards these important goals.
There's a couple things I want to hit there. And the first one, though, is it's all built on the idea of diversification, which is built on the idea that you can't predict the flight pattern of the leaf in the hurricane. You just can't. And yes, being diversified means you're always going to need to, you're always going to be upset with some of your investments, right? But our approach here, especially in light of what these indicators could be saying, is you should have a diversified approach. Yes, I meant to say that twice. We'll tell you a little bit more about what I mean by that, as well as talk about, all right, how are you going to handle the next recession? That and more coming up here on Wise Money with Korhorn Financial Group.
There will never be another recession ever.
Yeah. Am I doing it too much?
17
Was
times.
I doing that?
You counted it?
I'm not. My CDO is kicking in.
God gave me 5 fingers. Just kidding. Oh, there we go.
How can I help out? Pick up the noise.
All right. 4th segment.
All right, what are we doing here? I haven't looked at this.
Do we do any current event stuff? Fed Chair Powell to discuss monetary policy in Jackson's Hole. We could do. Okay.
Recording on YouTube.
All right. So we are looking at number 4, segment 4, leading into segment 4.
So we'll finish a little bit with the 3 investment philosophy. There's just a little bit more, and then we can go into, all right, what are you going to do during the next recession? Let's talk about it. Let's talk about it right now. So, all right, we'll hit that 4th segment, land on the plane.
I'm willing to bet the first thing is that they wouldn't have supported an online sales tax.
You're probably right. You're probably right.
I don't know. 51% of the households with children are getting a check from the government. So
52.3.
it's north of 50. So I'm saying that every tax in every way, shape, or form is going to be supported from here on out.
If the stock market is at a high level right now and the next 10 years do look a little bleak, what should you be doing about it? That's what we're talking about on today's show. If you've missed anything, let me tell you, you can go check out the full episode and every other episode a few different ways. You can find all of them on the YouTube channel. Just search Wise Money Radio. You can subscribe to it. You can like it. They're all right there. I got to tell you, it is somehow just a little bit more stimulating to watch us in the studio and listen to everything. But that's your choice. I'm just saying, that's my opinion. That's your choice. So you can find every episode right there. You can watch it. You can also find us on podcast, iTunes, Google Play. Just search Wise Money with Korhorn Financial Group. That's Korhorn with a K. Subscribe to that. Share those, all sorts of different things. And lastly, every episode's also on the website, wisemoneyradio.com. Great news there is you can also leave us a question if you'd like, just right there on the right. Submit your question. That turns into an email, goes right to me, and we're all set. We'll hit it on an upcoming show. Today, we've been discussing the stock market, that there are some indicators out there suggesting it's at a high level. And actually, there's pretty loud article recently in the Wall Street Journal with a pretty scary tone. And so we're addressing that today, talking about, listen, there's, it's just anyone's guess. You need to have a process. You need to have philosophy. You need to have guiding principles as it relates to investments. Before I ask a really big question about behavior, let's make sure we share a little bit more about our philosophy here. So we believe in having a diversified approach, but we believe in diversifying your strategies. So it's having diversified strategies and diversification within each of them. So if you're just using diversification, then you've got a recipe of U.S. and international stocks, bonds, real estate, cash. That's good. That is good, and you need to stick with it, even when the market's telling you, things could be high or whatever. But what happens when everything in each of those baskets moves in the same direction at the same time? You need to have a different strategy that might not move in the same direction, right? And so we offer that here. We've got some momentum strategies. Right now, it's interesting because if the market is high, and if you're worried about it, and if you don't want to ride through that, do you have a disciplined way of making changes to your investments? And that's something that we offer at KFG. It's a momentum strategy, and it's not trying to time the market. It's tracking the momentum of the market. Those are two different things.
These 3 different investment philosophies, they each have a name, and the first one is called a strategic approach to investing. And this is the most traditional way of investing. It's probably the way that you're managing your own 401k. You're following a certain recipe of or a mix of investments, and the hope is that you're sticking to it through the ups and downs of the market. You're not making lots of changes based on what you think the market is going to throw at you next. The second is a tactical approach to investing, and this is one where hopefully a professional money manager is helping make subtle adjustments within the portfolio, leaning a little bit more aggressive or growth-oriented at times and maybe more conservative at other times, depending on where we are in a market cycle. And then the third one, that momentum strategy that Mike was just talking about, is known as a dynamic approach. And this is a philosophy that's trying to focus in on the bright spots within the investment world, not try to hold everything all the time, but instead hold the stuff that makes sense right now and have a disciplined approach for getting out in the future. Not one of these is right all the time.
Exactly. It's diversification. So you're always upset at some of your investments when you're diversified. And same with these strategies. You're always looking at one of them saying, why is it performing that way?
That's right. So what we help people to do is piece together in the right proportions how much money you have in each of the three philosophies based on where you are and what your goals are. Again, it all goes back to that financial plan that defines what you're trying to accomplish with the money.
That's right. That's right. Speaking of financial plan, here's the big question. And I think it really underscores really what we've been talking about today. What are you going to do in the next recession? You know, we're riding this 10-year high of the stock market, and it's been a very, very emotional ride. And we don't know where the market's going to go tomorrow and for the foreseeable future, but we do know it's inevitable. We'll have another recession. We're going to have lots more. What are you going to do? What are you going to do? Say over the next year, stocks find themselves down 25%. What are you going to do? And what should you be doing now to prepare for it?
Mm-hmm. You know, one of the conversations I seem to be having over and over with a lot of folks who are, coming up to retirement in the next handful of years, let's say, I've been challenging them to start saving more for retirement. And that's not because, look at the fabulous run you've been having. Let's just keep piling more in because it's a fun time to be an investor.
Josh, you're to blame for this ratio being out of whack.
That's right. That's right. The point here is I do believe, and I don't know when it's going to happen, but there's going to come a time when the investment world is unfriendly. And it's not just going up, up, and away. There's going to be more choppiness. There may even be an extended down period of time. And that is a fantastic buying opportunity for someone who is still accumulating for retirement. This might be your last great bargain opportunity before retirement. And so you want to take advantage of it and maybe even take advantage of it to a higher degree than you have in the past. And the discipline of saving more for retirement is one of the ways that you take advantage of it. It also has the effect of reducing what you have available to spend right now. And kind of disciplining yourself, forcing yourself to maybe live on a little bit less right now could be great preparation, great dress rehearsal for what retirement could be, because what if there is a 2-year stretch where you need to live just a little bit more conservatively while you let your investments rebound from the next decline? These are things you don't have to do, but if you'll choose to do them, it could make all the difference in the next few years.
Very wise advice, Josh.
Yeah, I love what Josh is saying. So if I'm thinking about this, I'm thinking if I'm approaching retirement, I might want to work longer. I might want to save more. I want to be very aggressive about whatever debt that I might have on the books. Mm-hmm. But if we were talking just about the investing birds and the bees, we would say a couple of things. One is when the market goes down, and we're talking about, hey, when the market goes down, invest more. You're going to hear a familiar refrain. It's different this time. Mm-hmm. So you have to ignore that refrain. It's not different this time. So you need to be prepared to invest. And if you want expectations, I would expect a down market 2 out of every 5 years. And you might look and say, well, wait a minute, look at the last Look at the last 10. We've only had one, or have we even had one? So you say, well, that hasn't proven true. And I say, well, that's fine. Plan on it.
Yeah.
That way, when it happens, you won't be disappointed.
That's right.
I've been encouraging a lot of people to actually quantify what the next decline could do within their portfolio. So if on average, history
Yeah.
has shown.
They don't call him Mr. Fun for nothing.
Yeah, come on.
That's why Josh's middle name is the wet blanket.
Okay,
Just kidding. Go ahead.
So,
So
continue,
this-
Eeyore. Continue.
Do this math, though, because it will help prepare you for the emotions that you're going to experience. If every 5 to 7 years the stock market has a pullback that we call a bear market, it doesn't even trigger a bear market until it's fallen 20%. The average bear market is down 30%, though. Now, if you're diversified, you're working with a certified financial planner, we wouldn't expect your portfolio to go through that. But what if it was half? What if it was 15%? And, a portfolio of $1 million. Mike, you want to try to do that math?
No, not in the air.
150 grand.
Learned.
150 grand. You know how much effort and sacrifice it takes to go save 150 grand. If there was that kind of a swing, what will your response be? Now's the time to choose and choose wisely. That 150 grand isn't going to sink the ship. It may stir some emotions, but it doesn't have to ruin retirement for you.
For a lot of you, your response right now should be making sure you've got the right financial coach, making sure you've got the right financial plan, you have the right financial perspective, so you're making the right decisions at the right time, even if we start getting into some difficulties and challenges in the stock market. That is all the time we have for today. Thank you so much for being with us. On behalf of Josh Gregory, Kevin Korhorn, and all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.